Hello, my name is Richard Claywell. Welcome back to another episode of Litigation Speaks. Today I want to talk about mastering the statement of cash flows. First question is, what is a statement of cash flows? What you have in the financial arena is an income statement that shows the profitability. You have a balance sheet which shows the assets that you have. The problem is those two don't reconcile with each other. So you come up with a statement of cash flows that reconciles the operations between those two statements. And that's a critical statement to have, and actually it's known as the holy grail of financial statements. You probably haven't seen it. Most business valuation experts do not include that in the report. Most business valuation experts do not do the analysis of the statement of cash flows. So look for that. Attorneys play a critical role in guiding their clients through complex legal and financial decisions. Understanding the intricacies of these financial statements is crucial, particularly the statement of cash flows. It's essential for guiding legal advice to your particular client so they really understand what's going on and their decisions are being a better type of a decision. The statement of cash flows divulges the actual operations of the company, whereas the balance sheet and income statement kind of partially do. This, again, reconciles everything, puts it out there. And it highlights the cash operations or the cash flows within the company so you have a better idea of what's going on with it. So understanding this particular document will empower you as the attorney to better understand what's going on and to better advise your clients when these issues come up about what about this, what about that, can I do this or can I do that? You will have a better understanding of what's actually happening within the company. The statement of cash flows consists of three primary areas. One is the operations of the company, what's happening with that, and we'll talk about more of that in just a minute. It talks about the investing activities and the financing activities. And you're not going to get this information in the balance sheet or the income statement. The only place you're going to find it is in the balance sheet. So the operating activities, excuse me. The operating activities is going to show the operating cash flow that you bring into the business. And that's going to come from your sales or services that you have. So with that, you can kind of see what's going on with it. It's going to be replicated, should be replicated from the income statement, but you also want to look at those changes from year to year. It's going to also show any interest income that you've received. The question becomes, where did the interest come from? Do we have a lot of investments that we don't really need to have? Should that cash be reinvested someplace else so it produces a higher return for us? We may have some dividends that we've received. That typically would come from another corporation that we have an investment in. Do we really need to have that investment, or is that investment dragging the company down? You're not going to see that, what's going on with that in the balance sheet or the income statement very clearly. We also have outflows, the payments to suppliers. What is that going to be each year? And we're also looking for the changes from year to year for that. We're looking for where the salaries are that we've paid. Typically, it's going to give you the total salaries for everybody in the company. You don't have it broken out by individuals for that. It's going to show you how much interest was paid. So it gives us some idea of the debt service, partial debt service, because we have the principal, but give you some idea of the debt service that needs to be paid and the income taxes that are being paid for the particular company. We have investing activities. The investing activities deals a lot with acquisitions, i.e. I mentioned a minute ago that we may have some other corporations that we're involved with that we were invested in. Do we have that? How many do we have? Do we need more? Do we need less? How are those investing activities impacting the value of the company? Also, we have the disposal of long-term assets. When we're getting rid of these assets, we start to sell these off. That's going to increase our cash flow. But now, as we're selling off the assets, whether they're operational or non-operational, then we're not going to have those assets in the company, and that could deter the earnings that we're going to have. So these are some ideas and some things that this will help us understand what's going on with a particular company. When you look at the statement of cash flows, you're going to see whether we have any research or development, whether we have any expenses for capital expenditures. Now, you're going to see that historically. When you do evaluation, you should see a projected statement of cash flows. What is being projected for the capital expenditures? Here's where this is coming from. I'm telling the valuation expert that my company is going to grow by whatever, but I don't have any growth in my expenses over here or my acquisitions to support that. So we're going to have a consistent, sustainable growth over X number of years at X percent, but we don't have any asset base to support that revenue growth. So how are we going to do that? And that's a question that you can ask your opposing expert and the expert that you've hired. Have they looked into that to understand what's going on, and have they considered that in their valuations? Typically, I don't see that analysis in a valuation report. We want to look for large outlays of cash. What are those large outlays of cash for? It's very, very difficult to pick that up on the income statement or the balance sheet. But on statement of cash flows, it pops out like a red flag. So it's there. It's just a matter of trying to figure out how to do that or where that's at. A positive cash flow indicates that we're actually getting cash into the company. So if we have the cash coming in, now we are in a position where we can pay our bills, we can buy new equipment, we can buy new capital expenditures, pay off our debt service, and actually operate the company fairly efficiently. So we want to look at that, and we're going to get that information from the statement of cash flows. We'll look at borrowing. If you look at the balance sheet, what you're going to see is I've got, depending on how the CPA presents this, you're either going to see one or two large dollar amounts for the debt service, and then you can see like a miscellaneous or other debt. On the statement of cash flow, typically you're going to see more detail for that. And what we're looking for is how often do we go to the bank or a financial institution of some type and actually borrow the money. If we're borrowing really, really often, then the question becomes, why? If we're generating sufficient cash flow to support the company, the operations of the company, then we really don't need the financing. So if we have a lot of financing, the question again is, why is there a lot of financing going on? This comes from the statement of cash flow. It tells us where this is at. If we have a negative cash flow, we could be losing money, maybe not. If you go back and look at the income statement, you're going to see that you have a net profit, but that's going to include non-cash expenses. The statement of cash flows is what it says, cash flows. Whereas the income statement says how much income did you make, and you have both out-of-pocket cash expenses and non-cash expenses. So the statement of cash flow is extremely important to be taking a look at that. We wind up with free cash flow at the bottom of this thing, and that's going to be our cash flow from operations, positive or negative. Then we're going to subtract our capital expenditures, the new investments or replacement of the investments that we have to keep the company operational. That will give us our free cash flow. You're not going to get the free cash flow off the income statement. That's just not what it's designed for. When you get a business valuation, you will see free cash flow, but you will also see it in the statement of cash flows. Excuse me, I'm sorry. So it's important for an attorney to understand this because they're better able to field questions when they're talking with the client. Another key area for attorneys is this goes into the analysis that we're looking for when we're doing a forecast. Did I consider these types of items? If I did, how have I treated those in my forecast? If I did not, why not? So you need to find out what the impact, the opposing expert, what would that impact have been, hypothetically? And then we'll give you some sort of an answer, and have you done that? No, I haven't. You're the attorney. You know how it goes from there. So put your opposing expert on the spot. Saying that, make sure your expert did it first before you start criticizing them, because if they didn't, they're going to reciprocate and try to destroy your expert for that also. Thank you for listening. Check the links below for more information and comment below with feedback, if any. And I would be interested to find out what your feedback is on how often you see the statement of cash flows and what is your level of expertise in doing this. If you have any questions on how to interpret the statement of cash flows, feel free to give me a call or send me an email. I'll be more than glad to talk to you. Thank you very much. See you next time.